Perfect. Hi, everyone. I first want to say thank you for joining today for our webinar titled Money Moves and Financial Wellness, Budgeting and Investing in 2026. And I want to congratulate everyone on taking the charge of financial freedom. And with the help of our expert speakers, this session will be filled with insightful information on how to budget, invest effectively, and strategically. So for introductions, I'll go first and pass it on to my senior director, Lori Shreve Blake, and we'll introduce Simone Jackson, who is the Director for Alumni Career Services from the USC Alumni Association. Then our wonderful speakers will give a brief introduction of themselves and their respective roles at their current organization. So first for me, I am Jayla Eloy. I'm actually a graduating senior at USC. I am studying business administration with a minor in culture, media, entertainment, and emphasis in analytics. So at the Career Center, I am the employer recruitment intern. So I work specifically on the partnership program team with Lori. And it's basically a way to get employers at USC and show off our great talent here. So it's really great working at the Career Center and with Lori. So I'm going to pass it off to Lori to introduce herself.
Thank you. Thanks, Jayla. Jayla was a big part of this event, giving me what do seniors want? What do students want? And alumni as it relates to financial literacy and wellness. And so it's been a pleasure planning this event with Jayla. I'm Lori Shreve Blake, and I'm the Senior Director for Career Engagement at the USC Career Center. And welcome to our webinar around budgeting and investing this evening. It's my pleasure. We don't do things just alone here at the Career Center. We're very collaborative. And so it's my pleasure to introduce our partner for this event, the USC Alumni Association, Simone Jackson, who's Director of Alumni Career Engagement, who will give a welcome. And then we'll pass it back to Jayla and we'll do a survey, a poll question before we get going. Thank you. And thanks to our speakers this evening for sharing their wisdom.
Absolutely. Thank you so much for the warm introductions. Hi, everyone. My name is Simone Jackson, as Lori shared. My pronouns are she, hers, and I am the Director of Alumni Career Engagement here at the USC Alumni Association. We are here to make sure that you feel that the Trojan Network still lives on even after you graduate. So if you're an alum, I'd love to see you in the chat and say hi. And I'll pass it on over to Jayla so we can get started.
Perfect. Thank you so much, Simone. So we're going to start with the poll before we get to introducing our speakers. And this is an icebreaker just to know what background you have with budgeting and investing and what you're willing to learn. So I'm going to launch that now. Perfect. We're getting a lot of just learning, which is great. Gonna give it a few more minutes just to get as much answers as you can. Perfect. So right now we don't have many experts, which is great. There's always room to learn. About 47% is saying just learning. So that's great that you're taking action and being in this webinar now just to learn as much as you can. So thank you so much for everyone who answered. Now moving on to our introduction. So we're going to ask each speakers to briefly introduce yourself, any financial designations that you have, and more talk about your role at your current organization. So for order, we're going to start with Julie, then we can go to Megan, Ellie, and then Erica.
Awesome. Hi, everyone. Thank you, Jayla, for inviting me. My name is Julie Markson. I am a workplace financial consultant for Fidelity Investments. I've been with Fidelity for about 9.5 years now, and I started in financial services with Merrill Lynch back in 2014. And at Fidelity, I work directly with some of our largest plan sponsors to drive participant engagement in their workplace retirement plan. Part of my role entails providing financial advice through face to face meetings, one on one appointments, workshops, help desks, benefits fairs. My main goal is really to make sure that the participants of our plan sponsors are prepared to make better decisions regarding their personal finances, ensuring industry leading customer satisfaction results are achieved. And I hold both the certified financial planner and the equity compensation associate designations.
Perfect. Thank you so much, Julie. Now moving on to Megan.
Hi, everyone. My name is Megan Brinsfield. I'm the president of Motley Fool Wealth Management. I'm a certified public accountant as well as a certified financial planner. And I do not have an affiliation with USC, but I very much appreciate and am honored to be part of the panel today. And in my role as president of my organization, I'm really taking on quite a bit, wearing a lot of different jester caps, as we say at our organization. Um, Everything from meeting individually with clients all the way through to marketing strategy, operations, hiring, and we are actually going through a business merger right now. So that's been a fun learning and growing experience.
Perfect. Thank you so much, Megan. Now moving on to Ellie.
Hi everyone, Ellie here. I work in equity finance at BlackRock on the securities lending trading desk. My role sits in the intersection of markets, data, and risk. So I spend a lot of time thinking about supply and demand, pricing and efficiencies, and how to systematically generate returns. Outside of work, I'm really interested in how individuals can apply those same data-driven thinking to their own finances and investing decisions, because ultimately a lot of the principles translate pretty direct to it.
Perfect. Thank you so much. And last but not least, Erica.
Hi, everyone. I'm Erica Bickford. I am a support specialist at YNAB, which is a money management app. And I can talk more about this later and share a link, but we do offer a free year of YNAB to college students. So I highly encourage you to take advantage of that. I have my master's in USC in elementary education. So my story is a little bit different than some of the other panelists here. I was an elementary school teacher for about 6 years. And then in 2018, my husband and I were thinking about buying a house and starting a family. And I just like kept asking, how do people afford life? I don't get it. So a friend recommended YNAB to me. And it's been a game changer for us and our finances. It ended up being a game changer for my career as well. I've been there since 2020. And my main focus is just helping customers get familiar with YNAB, learn how to use it and make the most of it, and to answer any questions they have.
Perfect. Thank you so much, Erica. We're actually going to jump in right into the budgeting questions, and we're going to start with you. So the first question is, how do you build a budget that actually works long term, not just for a few weeks? And can you talk about the difference between simply tracking expenses versus truly budgeting?
Yeah, definitely. So as I said, I was already kind of into my adulthood when I found YNAB. I was a spreadsheet girl, so I kind of forecasted. I knew how much money I had coming in each month, and I knew what my basic monthly expenses were, rent, utilities, groceries, all that fun stuff. Um, but I often found no matter how much I was tracking things, it still felt like I didn't know where my money was going. It's like the numbers add up in the spreadsheet. What's happening in real life? Why do I feel like it's so tight? So what YNAB helped me realize, and I think the key to building a budget that actually works long term is multiple things. One of the first things is to focus on the money you have right now in your accounts. Some of the other panels will talk more about long-term investments, but YNAB really focuses on like your cash flow. So money in your checking account and your savings account. We encourage you to make a plan for your savings account as well. So instead of just lumping it, throwing it in a savings account and saying, yep, that's my savings, we encourage you to be more mindful about what you're saving for. What goals do you have? Is it an emergency fund? Is it home repairs, travel, whatever it may be? So I think focusing on the money you have right now, instead of forecasting, which is a big change for a lot of people from what they've done in the past, it really forces you to think about the trade-offs. Like it's reality, right? It forces you to live in reality instead of this theoretical world of what the year may look like. Another really important thing is planning for what we call true expenses. So this was really like the game changer for me. In that spreadsheet, I had my basic monthly expenses. What we often don't think to plan for are things that we know will inevitably come up, but maybe we don't know exactly when or exactly how much money it will cost. So the flat tire, car repairs, annual memberships, whether it's Prime membership, Costco, all those types of things. If you celebrate Christmas, it comes every year. We know it's going to cost money, but a lot of people don't tend to plan for it throughout the year. So it still feels like a shock. So that is key as well. I think just creating a buffer slowly over time, which kind of comes naturally when you're doing these other things, and planning for some of those more surprise expenses is helpful. Um, the other couple things I want to mention that are important are being flexible. Like life happens, right? So I'm not doing a demo of YNAB tonight, but again, I encourage all of you to try it out. What you would do is set up categories that are fit for your life and your typical expenses. And you can create targets and say, I should save X amount of dollars for my mortgage or rent each month. And YNAB will prompt you to assign money into that category each time you get paid or have an inflow. But things happen, right? So yeah, you can be planning all the way into next month, then an emergency hits, you had a little bit of a buffer maybe. It takes time to build that up. And you need to move some money around. That's okay. We encourage it. Nobody's perfect. We're not robots. It just again forces you to think about those trade-offs. Or it doesn't have to be an emergency that forces you to be flexible. It could be, oh, I only put $100 in for dining out this month. I really want to go out with some friends. That's totally fine. Like YOLO, live life. That's probably an old term. I'm showing my millennial self here. But I think, it just again makes you think about, okay, sure, I want to prioritize going out with my friends, but where am I going to take that money from? What other category am I going to pull that from? And then the last thing is staying engaged, and this kind of touches on your next question too about simply tracking versus truly budgeting and proactively making a plan for your money. YNAB is not a set it and forget it tool, which some people are surprised by. You can link your bank accounts and have transactions import and all of that. And there's lots of features that make it efficient, but it is built in a way that's expecting you to interact with the app. You need to, the point is to build awareness about your spending and get a sense of where your money's going and what your priorities are. So I think just being mindful and getting some sort of routine is really helpful too, about whether you're checking it once a week or once a month. It's important to keep up with it. And then that again goes with the tracking piece. I think a lot of other money management apps out there, you can link your accounts. It will tell you this is how much you spent last month on, housing, food, travel, fun, whatever it may be. Great. Now I have an idea of what I spent my money on. But unless you do anything with that knowledge, it's not really going to help you in the future. So, building a successful budget that's going to last and help you build that buffer and prioritize what you want, what's important to you, is more about making proactive choices. And that kind of goes back to what I was saying, focusing on the money you have right now, and really thinking about where you want it to go.
Perfect. Thank you so much. Seems like YNAB is definitely a tool that college students and even alumni would be very, very benefited from using. So thank you for giving us a breakdown.
You're welcome. I will just say one last thing. I always say that I wish I found it sooner, because I do think our expenses and spending tend to be simpler, when you're right out of school. So it's a great time to get in the habit of using a budget when it is a little bit simpler, and then it just becomes part of what you're doing as more of life happens.
Perfect. We're going to move on to Julie for the next question. So, our question is, as a certified financial planner working closely with individuals, what do you see as the key components of a healthy, realistic budget? And what are some of the pitfalls to avoid?
Well, first, Erica, I just want to tell you, so I meet with people day in, day out, and people love YNAB. So, and I had never heard of it 2 weeks ago. And then I had I was in a participant meeting and they were like, oh yeah, I'm checking my YNAB. I said, what is YNAB? Anyways, I've now heard it 3 more times in the last 2 weeks. So,
Oh, that's funny timing. I love it. That's great.
yes, it's very popular. So I've heard wonderful things. I'm gonna have to take a look at it myself. So, I talk about budgeting day in and day out. I tell people it's the bedrock of any financial plan, because if we don't know what you're spending and what the cash outflows are, we're not going to know how much that you can invest and start saving towards your longer term goals. So at Fidelity, we employ more of a framework for a budget versus like restrictive budgeting. And I feel that having, kind of piggybacking off Erica, having kind of a flexible budget too and not so strict will help keep people from falling off the wagon, so to speak, and hopefully to circumvent pitfalls. And the framework that we use at Fidelity is the 60-30-10. And I will go through this with folks like in meetings. Okay, because sometimes people just say, hey, I just need some help. Okay, you've helped me with my 401k, but how do I have a budget? So we employ the 60-30-10 framework. 60% of take-home pay should go towards the essential living expenses. What are the essential living expenses? Those are the must-haves, the things that you can't live without. Roof over your head, so rent, mortgage, utilities, groceries, debt obligations. No more than 60% of your take-home pay should be going towards that. 30% of take-home pay should cover discretionary expenses. This is what I call the fun money, eating out, travel, entertainment, shopping, hobbies. For me, it's my Amazon addiction. These are the things that add zest to our life. And Fidelity, we do believe we want you to live for the here and now as well, in addition to saving and planning for the future. So it's kind of about striking that balance. So we've got 60, we've got 30. And then the final 10 of your take-home pay should be used to pay for other goals. That could be building an emergency fund, maybe saving for a down payment on a home. Maybe you're just looking to dip your toe in the water to additional investing above and beyond your 401k. That's what that 10% is there for. And of course, we do encourage folks a pre-tax income for you to be saving, around 15% towards retirement. That 15% does not all fall on you. It's also in conjunction with what your employer would contribute. So those of you who are maybe interviewing right now for jobs and you're looking at these companies, taking a look at what their benefits are, find out, what is the employer match to my 401k? We want an employer that's going to help you reach that long-term goal as well. So what we don't want, I don't want people to feel like they're penny pinching just to get to this long-term goal of like retirement or whatever it could be. But again, it's about providing this framework. And this framework at Fidelity, the 60-30-10, it was recently changed. And the reason being is because, and Erica kind of spoke about this, the financial realities that we are facing nowadays are a lot different than what people were, than what I was facing when I graduated USC or what my parents were facing. Life is a lot more expensive. Mm-hmm. Especially if we live here in California. We know that I talked about this 60%, that's going to be a lot of, like, if we buy a home, most of our home payment's going to go towards that 60% of take home pay towards essential living expenses. But again, it's there to make budgeting less intimidating. It's there to make budgeting more intuitive. And I truly believe that'll help people stay accountable. And it's just about being intentional and smart with your spending, which in turn is going to empower you to have more, clear, actionable guidance for financial wellness. So try the 60-30-10. Again, if you haven't necessarily entered the workforce yet, but you're maybe kind of in that transition period, get organized. kind of write it down. I truly believe in like writing things down the old-fashioned way. So give that framework a shot.
Perfect. That's definitely something I personally will be implementing as I'm taking in different offers, seeing all the benefits that these different employers can have for me. So I think everyone should take that tip as well. Thank you. For our next question for Megan, it says, from your perspective, what financial habits make the biggest difference in someone's long-term financial future?
Yeah, so a lot of the clients that I work with are either getting ready for retirement or are in retirement. So they're like, later stage in their working careers and things like that, and have the benefit of hindsight and kind of telling me some of the things that they think that they have done right or wrong over the course of their career, their, wealth accumulation journey and things like that. And I combine that experience with one of my favorite books, which is Millionaire Next Door, and it talks about people who are great at building wealth are often not in a place where they feel like they can afford to save. They create an artificial environment of scarcity, meaning you are putting limits on yourself that aren't necessarily there in your budget, and in order to meet longer term goals. So I would say it is amazing how quickly small things add up. So you mentioned what habits, and these habits could be really small. Like I share a Netflix account so to save, $5 a month or whatever it is, all the way through to I work for an employer that matches 6% instead of 3. And these are the types of things that cumulatively start to make a big difference because they sort of have this snowball effect over time. So I would say a couple of specific habits that I've seen that work really well are folks that start investing early, and investing can take place in a workplace plan like, Fidelity and Julie's work. Or even just in a side account that you're saving for yourself. Um, if you identify when you do get raises as also increasing your savings in line with those raises so that you're never seeing a decrease, that's really mentally difficult, right? Is to like subtract from what you have already. And then just managing your debt. I know that is difficult to do, especially with student loans and things like that. I would definitely find an employer that can help manage student loans. There are a lot of tax changes that have just been approved that help employers either pay for student loan repayment or match. Instead of doing a 401k match, they match those dollars through student loan repayments. So a lot of employers are starting to pick these benefits up as they become new and approved. So definitely, as you're looking for jobs, those are ways that an employer can actually help you on your financial journey as well.
Perfect. Thank you so much, Megan. I actually never heard of employers matching the student loan forgiveness, so that's something that everyone should take into account. Thank you for that. Now, our next question is for Ellie. It says, for your work focuses on analytics and data-driven decision making. How can individuals apply that same mindset to managing their personal finances day to day? And a kind of a bonus question is, how does one break the just one sweet treat mindset? I personally am a victim of this. I always want a drink or, some matcha or iced tea. So how does one manage that?
Yeah, definitely. I would say, so I mean, the biggest shift is moving from kind of reactive to intentional or proactive. Just trying to be as mindful as possible. Most people track, they look at what they spend after the fact, but if you can budget in advance, you can kind of decide systematically in an organized way, like where your money's going to go. So similar to, let's say, managing a portfolio or whatever, essentially your money is your own portfolio. So your income is your capital. Every dollar has to be allocated towards something or any spend. So kind of echoing exactly the 60-30-10 rule. Like those are just very straightforward but well practiced and proven ways of budgeting and allocating where your money is going to go. And again, like realistically, things happen you can't account for, you don't know. So I personally believe living below your means is always the best and safest way, even if you do get a pay raise or you're getting paid more, like you never know what's going to happen and you never want to feel that type of anxiety financially. So if you can always kind of live below your means and control what's fixed versus what's variable and essentially what's fixed, like there's things in your control instead of maybe going out every day and eating food, you can cook your food, like it's
Mhm.
healthier and cheaper. Um, and then what is out of your control, you just have to hopefully have some money saved up for those instances. And also like echoing, taking advantage of all the different kind of tax advantage accounts when you start out in your career, you're gonna get paid, but maybe not above the kind of limit where you could set up these investment accounts like a Roth IRA or if your company, if you were corporate, has a 401k, I would always suggest maximizing at least the minimum where your company will match you because that's literally free money on the table that they're going to give you. In terms of the sweet treat, ultimately we do work hard in order to enjoy life and enjoy the present moment. So I'm not one who will sway away from taking a trip or enjoying myself and having that much if you really want to, but just be proactive, make sure the math makes sense, have a second of thought like, can I do this? It's okay to say no sometimes. You should never feel that pressure when you're alone or with a group and just similar to like a piggy bank or whatnot, like have a pre-allocation for the guilt-free money where you could spend it and enjoy why you're making money and working hard and what you can spend that on, what's important to you. I would say ultimately experiences should be most important over materials, but obviously everyone has their own kind of style or enjoyment.
Perfect. Thank you. Now I feel a little less guilty about getting that matcha today, so thank you. And for our last question in the budgeting category, it's more so a general one, so anybody can feel free to chime in. So I know everyone kind of touched upon this, but I want to know, as income and life circumstances change, how should someone adopt their budget to stay on track?
Sorry, was this for me?
Oh, it's for everyone. Anyone
Oh.
can.
I can chime in. I'm obviously always thinking about YNAB. But with YNAB, there, as I mentioned before, you're going to create categories that are aligned with your priorities and your goals and your expenses. And we encourage you to set targets for each of those categories. And as other people have touched on, some of your expenses are going to be fixed. That target is not going to change. Like mortgage payments, student loan payments, whatever it may be. But the more discretionary things, if lifestyle's changing, the big life change comes up. For me, it was looking at buying a house and having a family. That kind of can prompt you to evaluate the targets you currently have, how you're assigning your money right now, which more flexible categories can you make changes to. And I actually have my YNAB categories structured that way, like the monthly fixed, monthly flex. So it's pretty easy to go in there and know where I can make changes when I need to.
Perfect. Thank you so much. Um, any other tips, or we can move on to investing?
Jayla, I just wanted to say, I think also too the importance, and maybe I didn't stress upon it enough, but just the importance of also having that rainy day and that emergency fund.
Mhm.
That is there for the uh-ohs or the, I want a roof over my head, or maybe this vacation's costing a little bit more. Like again, Erica said this, we're not robots. So having that rainy day fund for you to be able to rely on and not have to incur additional debt, such as credit card debt, is really important. And Fidelity stresses 3 to 6 months of essential living expenses. So if your essential living expenses are $3,000 a month, we hope you have anywhere from 9 to 18,000, give or take, just sitting in that rainy day fund, no market exposure, no risk associated with it. that'll be the money that you can rely upon to help with the things that you just can't always account for. We don't always know when these unexpected events will happen. And I think having that too can help you from derailing your budget. So I just wanted to make note of that.
Perfect. Those are great tips. Thank you so much. Now we're going to move on to investing with Lori. Just take that away.
Thanks, Jayla. Okay, so now we're on to the investing questions, and then we'll have time at the end, after we get through with the investing questions for the Q&A. So please put your questions in the Q&A related to budgeting and investing. And I will start with my first question, which will be for Megan. What long-term investing strategies tend to be most effective for building wealth over time with options like stocks, bonds, treasury bills, certificate of deposits, digital currency, and real estate?
Well, thank you for the question, Lori. With the options that you mentioned, you listed a number of kind of savings mechanisms like treasury bills, certificates of deposit, high yield savings accounts. Those would all be pretty safe investments and a great place to stash your emergency fund or money that you think you're going to need near term, like less than 3 years. Within the Motley Fool organization, we always talk about you don't want to be putting money at risk that you're going to need in the near term, because that can really go any which way. And when you need money for, say, a house down payment or something like that, or buying a car, you don't want it to be subject to market risk and volatility. Of course, digital assets have been very popular in terms of conversation topics, but really not as much of an allocation within kind of traditional asset allocations, I would say. If you're working with a financial planner or even a robo-advisor, they're probably allocating very little, if anything, to digital assets just because the volatility is so huge. And there's not much of a history to base it on. When you're looking at something like the stock market, you've got 100 years of history that you can start to identify trends. And of course, past performance is no predictor of future outcomes, but we can start saying, looking at the past 100 years and saying, the stock market has been a pretty reliable place to build wealth if you're willing to invest in a long-term way, meaning 3, 5, 10, 20 plus years. That is a place where you'll start to see very significant compound effects. And you don't have to invest in individual stocks to be invested in the stock market, which I think is a common misconception when you're starting out, that you can buy an index fund that is really a basket of a number of individual stocks, that it's going to be well diversified, and you would want to cover not just US investments and companies, but look at international companies as well, and then all different company sizes or market capitalizations. So what we really try to do is match someone's risk and timeline to what they're investing in, because there's no such thing as a free lunch as in investing. If you are seeing something that's offering a high rate of return, it's because there's a lot of high risk associated with it, and you should be prepared for that asset to move down as well as up, particularly in short-term periods. So in terms of the most effective way to build wealth, just like there are a lot of effective diets, there are a lot of effective ways to invest. And so you have to really find the one that works for you and be willing to stick with it. What we really discourage is kind of that mindset of changing lanes in traffic, where you're in one investing style, you see something like crypto take off, and so you start to invest in crypto, and then that starts going down, and you're like, oh, over here, real estate looks great, and you buy an Airbnb, and then that tanks, and you start investing in stocks. All of that switching, every time you switch the investment strategy, it's kind of restarting the clock on the runway you need for that strategy to be effective. So I would definitely say just knowing yourself and knowing what you can stick with is probably the first step to having a successful investing strategy.
Wonderful. Thank you so much for that. And you mentioned index funds. There's ETFs and there's index funds. Is there one you recommend for a first-time investor making the first few steps in investing?
So sometimes those terms are used interchangeably.
Yeah.
An ETF is just kind of the packaging of a given investment strategy. It could be an index fund, it could be an active ETF. And there are now just as many or more actually ETFs than individual stocks. So there are a lot of different ways you can mix and match stocks or different investing themes within a particular ETF.
Wonderful. Thank you. Thank you for that. My next question is for Julie. Julie, with regard to the stock market, what is a bear market and what is a bull market? And how can individuals stay disciplined with their investments during periods of market volatility?
Lori, that's a very timely question. So thank you for it. So simply put, a bear market is one that's falling. Prices are coming down, receding. A bull market is one that's growing. Prices are moving upwards. The origins of the bull and bear motif, I don't know where that came from, but the reason why they're used, and you'll actually see the bull and the bear statues on Wall Street. The bull, when they're fighting, they tend to rear their horns upwards, again, signifying upward moving markets and upward moving trends and upward moving prices. And when bears feel threatened, they tend to, slap their paws downward. So, of course, prices are falling. These terms are used very frequently, especially when you turn on financial news. And they really are just kind of a quick barometer for investors like me and you to determine, again what is the movement of the market overall. Now, moving on to the other question, how do individuals stay disciplined with their investments during periods of volatility? This is tough because what we know with finance and personal finance in particular is that there is a lot of emotion involved with money. And that's one of the things that we want to extrapolate out is the emotion part. There is this phrase, I'm sure everybody on this panel has heard, it circulates the financial services industry. And that phrase is, it's not about timing the market, but rather time in the market. The market will reward those who stay disciplined and stay the course. So very similar to Megan discussing moving in and out of lanes, that's not what we want to see. We want to see folks who are staying disciplined in their strategy and trying not to let emotion get the best of them. So, of course, during periods of market volatility, much like what we're experiencing now, people tend to make decisions with emotion and maybe they're not thinking pragmatically. This is where we can really see a person's portfolio be derailed. The average investor does the opposite of what you're supposed to do. They get emotional, they sell at the low, and then they don't know the right time to get back in. And they're going to miss out on market rebounds. So it's natural to feel stressed in markets like this, particularly if you're close to a financial goal, whether that's retirement or maybe buying a home or whatever it could be. But it's really important to take a step back and actually have some perspective. So I love telling people this because this goes to show you the power of compounding. So if you take a step back, let's say that you had an initial investment of $10,000 and you put that $10,000, it was 1988, so 38 years ago. You put that $10,000 in the Standard & Poor's 500, the S&P 500. These are the largest 500 companies that trade publicly here in the United States. From 1988 to the end of, let's say, 2024, that 10,000 would have grown to 522,000. Just by doing nothing, you sitting back and letting compound growth work, it's magic. So over $500,000 is what you would have had if you just put your money in the markets and let it ride. And when you look historically what the markets have absorbed, think about the events that took place during that period. We think about the dot-com bubble of 2000, 9/11, the financial crisis of 2008-9, the housing collapse of 2008-9, COVID, hyperinflation of 2022. 2022 is the worst bond market on record. So the market is very resilient. You need to be resilient too. So we don't want you to have this tunnel vision and feel like we're in the worst case scenario. I think that's somewhat human nature, but volatility is normal. It's never a smooth ride when it comes to investing. So we want to just take a step back, breathe a little bit, look historically, have some perspective. The markets have gone up significantly over time. Not saying that volatility should be ignored, but it should not be feared. So I think just trying to change your perspective a little bit and think of times like this. Hey, it's a wonderful buying opportunity. Okay, we're going to get discounted prices right now. It's like bargain shopping. So everybody wants to get in at a bargain.
Thank you for that, Julie. And also, you don't know when the market will rebound, right?
No, you don't. And
Nobody knows that.
Yeah, and if we did, then you'd be very wealthy. And I do leave people with this because sometimes people, again, someone even today said, well, why would I want to invest now? And I sometimes ask them, well, what's the alternative to not being invested? And sometimes they come up with something, but the alternative, if you don't invest, it's guaranteed that you won't hedge inflation over time. So you're guaranteed to lose money and your buying power to diminish if you don't start investing over the long term.
Thank you. Thank you. So my next question is for Ellie. Ellie, based on your role at BlackRock, we thought this was a great one for you. How do data and analytics influence investment decision making at the institutional level?
Yeah, well, almost everything's driven by data nowadays, I'd say, especially at the institutional level, especially with all the new tech and AI coming into place. More people are enabled to use technology, whether you're a computer scientist or not, like you now have the access and ability to build and synthesize data, and see it in a simpler way. We're constantly on our team analyzing supply and demand, positioning flows, and pricing. Simple example, when these indexes, as we mentioned before, are doing rebalances, we can predict changes in demand for certain securities and position based on the liquidity, essentially the amount of shares coming in or out of these index ETFs. So ultimately, data helps us guess less and build more repeatable systems to identify patterns and inefficiencies over time so that we have more targeted approaches and more targeted decision making, which essentially makes everything and anything more accurate. And I mean, I would say, especially with this volatility right now in the market, a lot of it is driven by systematic type of funds, whether they're quantitative funds or algorithm based, and you see these large swings, but ultimately they kind of level off and revert back to the mean. So echoing what everyone said before, you obviously can't time the market. If you did, you'd probably be working for yourself and very successful, but just staying patient, staying tempered, and ultimately knowing that investing will help you in the long term. And what we have, especially you guys as students, is time, and time is your friend. So the longer you stay in, the more benefits you'll essentially gain.
Thank you, Ellie. Okay, my next question is for Julie, Megan, and Ellie. And this is for our sophisticated investors. So we do have alumni on this call as well. For sophisticated investors, what advice would you give to our students and alumni, because we have sophisticated student investors as well, in this current environment? And we'll start with Megan.
Um, I have a lot of clients calling and asking me this question as well right now, and it's a very frustrating answer, which is um, the this is not the time to sort of like change course on a plan that you had. So a lot of times you might sit down, sort of chart your financial goals, how you're going to reach them, your plans for savings and investing. And when something happens in your environment, whether it's large or small or global, it might knock you off of that plan or it might shake your confidence in executing it. And I think that's natural, but a lot of times, as Julie said, we want to take the emotion out of investing and really stick with something that is going to be really more methodical. Um, so a lot of times I also think people misinterpret sophistication as being the same as complexity. So if I'm a sophisticated investor, I must be doing really complex trading or strategies. And a lot of times the KISS method works just as well. Keep it simple and see the results of just sticking with it and compounding over time. So, as hard as it is, we try to think of what are the positive actions I can take even in a negative market environment. And a lot of times, those positive actions are continuing to invest, kind of turning off the noise and sticking to that long-term goal and plan that you had set up to begin with. So I know that's not a very exciting answer, and it might be a somewhat contrarian answer depending on the audience. But I'll start there and let my colleagues kind of maybe combat that.
Yeah, well, we hear a lot about dollar cost averaging. You said keep it simple, keep doing, keep investing. Um, so there's some power in that too, right, Megan? The dollar cost averaging with investing.
Absolutely. And that dollar cost averaging just means you are basically setting a schedule and investing on a schedule over time, no matter what the market is doing. And so that is really a very effective strategy for removing emotions and environmental factors from your investment plan.
Thank you. Julie?
Yeah, so first, kind of stepping back even more, create a plan for your money, list out what your goals are for the money, what's the time horizon, what is your risk tolerance. And once all of those are determined and the plan is made, then stick to it. Stick to the plan can be challenging again during periods of volatility, but it has been proven to be critical in driving positive long-term results. When we look historically at how markets have reacted during geopolitical events, we see that in most cases, stocks generated gains in the 1 and 3 year period following those hostile events. And again, very specific advice, just as you said, truly the dollar cost averaging is something that we encourage people to do day in and day out. If you have a 401k, you already are dollar cost averaging. So to kind of define it a little bit more, instead of investing large sums of money all at once, consider investing a portion of that sum on a regular schedule, regardless of which way the market is heading in. And we find that with dollar cost averaging, it really helps people to, again, take some of the emotion out of it. But what effectively you're doing is you're purchasing more shares when prices are lower, and that limits the amount of volatility in the portfolio that your portfolio experiences. And again, going back to everybody needs an emergency or a rainy day fund, if you have that rainy day fund to rely on, these periods of volatility, while they're very important, they may just not have that big of an impact on just the broader picture overall. So it's always good to have some cash on the sidelines that you can tap into. And it's good to have cash on the sidelines too during opportunistic periods like this, so that you can also make some smart purchases into the market.
Thank you, Julie. I've heard people call having money on the sideline dry powder.
Yes. That's a common term. We call
Yeah.
it dry powder. Just they're ready and waiting to use that dry powder to, like I said, make purchases at discounts.
Wonderful. Wonderful. Ellie?
Yeah. I'd say, I mean, pretty simple. Try to keep everything as simple as possible, first and foremost. Secondly, like Julie said, right now, honestly, it's probably a great time to buy. Everything's at a discount. Um, and whether you think it's going to go down more or this is the bottom, don't invest everything you have in terms of your dry powder today, but dollar cost average. Buy over the year or over 6 months, 6 times every single month or every 2 weeks. Because obviously you can't time the market. It's a graph that goes up and down. Like hopefully ultimately it will go up, but don't fear when things kind of go down. If anything, take that fear and that uncertainty as a good opportunity to start buying. I personally started during COVID, so it was a really big learning curve for me. Um, and it was a great kind of discounted buy, and I believe in the American economy and I believe in these top companies that we have. So ultimately, I just figure that over time, people, especially the smartest people working on these companies and on the innovation, like they're gonna figure it out, and I have full faith in them. Uh, Also, yeah, I keep dry powder always for times like these. And then in terms of let's say like breakdown or whatnot, you have to just know who you are and what your risk tolerance is. Some people have more risk tolerance. They could swallow their portfolio being down 20% within a couple days. Others can't, and the emotion goes in. So just really listen and know who you are. When you do invest in these things, me personally, I think very long term. So am I going to buy this today? I will only buy it if I think that I'm going to hold it for the next 5, 10 years. I'm not going to buy it and be like, oh, maybe in a month I'll sell. Like that, you might as well just go to the casino, honestly. And then in terms of maybe taking some bets or some risk, like you can allocate certain percentages to those bets or risks. So let's say AI is super volatile and there's a lot of promises and no one really knows which companies are going to end up being the winners and whatnot. If you want to bet, maybe bet small bets on these companies, diversify. And if you don't want to bet individual stocks, invest in an ETF where a professional money manager is actually doing the research, allocating shares, diversifying them. So you're betting on industries or themes and sectors as opposed to individual companies.
Wonderful. Thank you for that. I have a follow-up question. Whoever would like to answer it. We've talked a lot about time in the market. Julie gave that wonderful example of graduating in 88 and what that account would be worth, 500,000 plus. For people who don't have that much time to be in the market, let's say they, want to retire in 5 to 10 years, what advice would you give them?
It's still important. This is where kind of the diversification piece comes into play. So even when you're, let's say, nearing retirement, doesn't mean that you shouldn't be in stocks, because what if you live 40 years in retirement? We still need that money to grow and compound. I think it's just a matter of perhaps rebalancing the account to adjust for the risk and the capacity of risk falling. And so making sure that we're integrating other asset classes in it, whether it's cash, bonds, just the echelon of various investments that you can have in your portfolio. It's all about having a mixture. And within the stock side, there's so many different ways of diversifying and ways to limit the risk. There's diversification through style of stock. Is it growth stock, value stock, geographic exposure, domestic stock, foreign stock? What industries are we exposed to? Of course, there's tons of exposure to tech, financial services. Maybe we need more consumer discretionary, consumer defensive, more utilities. Again, just getting the array of various investments within our portfolios, having that array is really what can help you limit volatility. And that's what we speak a lot to participants and clients as they're getting closer to retirement.
Thank you, Julie. Anybody have anything to add to that? Okay, so my next question is for Ellie. Ellie, from your experience working in equity finance and market structure, what insights about markets do you think individual investors often overlook?
I would say ultimately markets are driven by flows and positioning. So although fundamentals should end up being the most important, it's not always true that a fundamentally sound company will be going up or down. It's um the market could stay irrational longer than you can stay solvent. So understanding that is one big theme or important fact that kind of gets overlooked. So there are other kind of strategies like we keep saying as well. And I'm a big believer in ETFs, although maybe not as fun or whatnot. If you like kind of betting or talking with your friends, oh, I think this company, but it's it's a way to diversify that and um it helps a lot essentially. People underestimate how important risk management is. The top firms, the top banks that are here today ended up surviving all of these big bubble bursts and recessions, and that was solely due to their risk management, not because of their aggressiveness, but because in times of turmoil, they're healthy and balanced and able to survive these things. So gains are great, but more importantly is avoiding big losses.
That's wonderful. That was very good. Avoiding big losses, very important. Okay, and like you said, the big institutions. I heard that, yes, Berkshire Hathaway, Warren Buffett, he had has a lot of dry powder on the side. Just to your point about risk management and avoiding major losses. Okay, so our final question, and I'm going to bring in Erica to this as well, is if attendees could take away one bold step after today's webinar, what should be and what should it be and what does it look like to take full ownership of your earning potential over the next 12 months? So what's one bold step that everybody on this call, including the panelists, everybody who's listening right now, and those who will listen in the future to the recording, can take one bold step in the next 12 months to secure their financial future? And we'll start with Erica because we haven't heard from her in a bit.
All right, this probably seems obvious, but I would say sign up for a YNAB account. Now is the best time because especially if you haven't graduated yet, get your free year before that opportunity goes away. And it looks like I'm not able to share links with everyone, but I can pass those along to Jayla to share out to everybody. And invest some time in looking at our resources. We have some great free workshops that explain the YNAB method. It's been great to hear from everybody else because I think everything ties together really nicely. If you get a system that works for you, like YNAB or whatever else may be a good fit for your needs, now, and as I said earlier, get into the habit of engaging with your finances, really building awareness of where your money's going and what your priorities are. It will just be a lifelong habit. And you can structure your YNAB to reflect a lot of what we talked about today, that 60-30-10 format, and make sure you have a category for your investing, and all of that. So I think it's a pretty simple step, but it could be a really powerful one for you.
Thank you. Megan?
I know we talked a lot about finances, asset classes, and investing, but one of the most powerful investments that you have is the investment in your own human capital. And so I would say, obviously, everyone that's here is working on an education path, getting a certification, etc. But knowing how to position that value in the marketplace becomes really important. And I would say it is a very valuable skill to learn negotiation techniques, do mock interviews, things like that, that are going to expose you to the uncomfortable conversations that you might have to advocate for yourself. Within the Motley Fool organization, we had an ask for a raise day. And the point of that was not to just show up and say, "Hi, I'd like more money, please." It was to kind of force people to engage with what are the most valuable skills that they have on offer. What is the organization paying a premium for, and what is the market for that outside the organization as well that would, prompt increased value. So I think that those decisions, particularly early in your career, have a compounding effect because most people are not, taking a step back on their salaries when they change roles. They're usually taking a step forward unless it's an intentional sort of career change. So the more you can do with that early on, the bigger impact it's going to have down the line because it affects every forward year.
Great advice. Julie?
Yeah, it's somewhat contrary to what we discussed because we went over investing a lot, but I would say start that emergency savings, start that rainy day fund. If, getting to 3 to 6 months seems like a bit of a tall order, try and get to 1,000 and start from there and have it snowball from there on out. But very important to have that cash on the sidelines so that periods, just like what we're experiencing now, are just not as much of a hindrance or a worry or a stress.
Thank you. And with regard to that emergency fund, would you encourage people to take on an extra side hustle just to, if they need to build it up and then get rid of the side hustle just to have that?
Sure, if you have the time, it's with side hustles, the juice must be worth the squeeze. So, I would encourage your side hustle to be something that you enjoy doing. It doesn't take a lot of time away from studies or your full-time job. And again, you just want it to be something that maybe you're passionate about or feeds your soul, and you just get a little extra money for it. So, yeah.
Thank you. Thanks, Julie. And last but not least, Ellie, what's one step we're all going to do?
I would say start treating your finances like a system instead of a series of decisions. The ultimate goal is not perfection, but consistency. That doesn't only apply to investing and work, but in all aspects of life. 2 steps forward, 1 step back. As long as you're moving forward and improving and learning from your mistakes and being consistent, you'll end up looking back and reaping the benefits, especially when it does come to investing in your careers.
Well, thank you for those pearls of wisdom. I believe we do have some audience questions, so I'm going to pass it over to my colleague Jayla, who will lead us in the Q&A.
Thank you, Lori. So we have a ton of great questions in the Q&A, and feel free to add more as I go on. So the first question is about Roth IRAs. So the question is, which one is better for college-age students? Roth IRAs or traditional ones? And anyone can take this question.
Go with the Roth.
Okay.
I think my colleagues would agree with me, but the beauty of the Roth is that you're funding it with non-deductible after-tax dollars. That money that you put in there, you then get it invested, and that money is going to grow and compound tax-free. So think about, again, if you started with 10,000, let's just say if you started with like 7,500, because that's the limit for Roth IRAs this year, and you just put it in the S&P 500, you left it in there for 30, 35 years, we know what it would be. It would be close to $500,000. That money would be withdrawn tax-free for you in retirement. If you're just getting out of college and you're just entering the workforce, you're probably, maybe not, but you may be just at the starting point of what your earnings potential is. So we want to lock in those gains that would be growing tax-free for you over time. So my vote's for Roth, but of course, everybody's financial situation is a little bit different. So speak with a financial professional to confirm.
Perfect. Thank you so much, Julie. Our next question says, what would be a good system for a 5-year investment timeline? Do you recommend CDs or bank-based investment account to start? Are there any investment platforms you recommend for starters?
I, I would say if I mean I wouldn't recommend a CD personally. I'm curious to hear what other colleagues say, but 5 years is enough time. I would stick to me personally. Like I just for the most part, the majority of my investments in the S&P 500 index. It's basically from what I kind of how I take it, it's a bet on America's economy on the top 500 companies. When and if companies that aren't performing well are in the S&P and dragging it, there's a rebalance and they will get kicked out. So there's always a refresh. In terms of an investment account to start, that's ultimately up to you. I use Schwab. I know a lot of younger people, a lot of my friends use Robinhood. I think it's a great platform, but it can be a bit gamified and enticing. So ultimately, you just have to have your own discipline. But yeah, just do some research. There's so many out there, and there's more and more always coming, especially right now. And um, yeah.
Perfect. Our next question is more so about credit cards, and I'm curious as well. It says, what role credit cards play in budgeting and investing, and the best tips for leveraging this tool, especially for college students?
I can take this also. For credit cards, I always go on nerdwallet.com. They are a great source for just really depicting what the best credit cards are for you in different categories, um, pros and cons. You want to build up your credit as quick as you can, so opening up a credit card account would be kind of that first step. Just always, like me, myself, I have my auto payments set on, so I'm never late to my payments on a credit card. If you miss those, they're crazy, crazy interest fees, honestly, and probably a nightmare. But as long as you know that you have enough money, enough dry powder, like I would always set up those auto payments, um, and use what you like. I travel a lot. I enjoy traveling, spending my money on that. So I use travel credit cards. If you go out a lot on dining, there's dining credit cards and whatnot. So just know who you are, and there's infinite different services there.
That's super cool and very insightful. I also wanted to extend this to Erica just to talk about YNAB and how that can be applied for the credit cards. Is there a way that you can apply it on the app or, use that source there for credit cards?
Yeah, definitely. I don't want to get into the weeds too much because without looking at YNAB, it can get a little confusing. But I do want to say that we have what's called a credit card payment category. So I would echo what Ellie was saying. I mean, you want to build up your credit. So I think credit cards can be really great tools for that purpose, but obviously you want to keep an eye on it and be, if possible, if at all possible, paying in full each month, so that you're not paying those crazy interest fees. So if you can use them responsibly, there's a lot of benefits to having credit cards. And YNAB does a great job of what that credit card category does essentially is if you spend $100 on groceries using your credit card at the grocery store, YNAB will automatically, as long as there's at least $100 available in your grocery category, YNAB's going to move that money from your grocery category to your credit card payment category. So it's setting aside the money as soon as you spend it, for your credit card payment. So as long as you have money assigned to the spending category where you used your credit card, YNAB's going to help you make sure you have the money ready to go, to pay it in full.
Perfect. Thank you so much. And this question is more so about like loan forgiveness program. So this person asks, is it possible to take advantage of the loan forgiveness program if it's only applicable after 30 years of being employed by a nonprofit? And they're saying by then they're assuming the loan amount would be prepaid amount at that point. So that's kind of their question.
I think what maybe they're referring to is the Public Service Loan Forgiveness, PSLF.
Mm-hmm.
And it's actually what the law states is that you need to be in an income-driven repayment program, and you need to have 120 or roughly 10 years of qualifying repayments back into the loan. There is going to be some paperwork, digitally that you're going to have to fill out every year. But it's not 30 years. It is a 10-year period. And by filling out the necessary paperwork and also working for a qualified employer, so a not-for-profit, think of hospitals, universities, for example, things of that sort, confirming that your employer is qualified under Public Service Loan Forgiveness. There is a website that I know that you can go to, and it's a federal website, and I'm sorry, it's escaping me, but you can check to see that your employer is qualified. And then again, doing the paperwork every year, and then just making sure that you are in the correct repayment program as well to qualify for Public Service Loan Forgiveness. And then after the 10 years, you'd be eligible for forgiveness.
Perfect. That's very insightful. Our next question is about life insurance. And they said, would you say investing more in your life insurance is beneficial for its cash value, or would investing be a better choice while paying a lower life insurance rate? If that makes sense, yeah.
I would say life insurance is typically not going to be the best investment vehicle. So if you think of like different tools being used for different things, a Swiss Army knife has a knife on it, but you probably wouldn't buy it to like carve a turkey at Thanksgiving. So if you want to invest. And if you need life insurance, buy life insurance. But if you're kind of mixing goals, you're going to get a less powerful version of both things. So that would be kind of my take on that.
Perfect. The next question is about treasury bills specifically. This person asks about like different strategies that are recommended alternatively than high yield savings or CDs. So they're curious about what tax advantages there are for treasury bills.
Ultimately, any income is taxable, so even if you invest in a T-bill and you're getting a monthly dividend and then your coupon at the end of the expiry, you're paying tax on that, and so there's no necessary kind of tax advantages there. The advantage is just lower risk. It's a lot safer of an investment,
Okay.
but yeah.
There are certain benefits, I think, if you use treasury bills to pay for education expenses, but that's not necessarily going to be like applicable across the board, and it's not all T-bills. It's like specific series.
Perfect.
T-bills also do have the income on T-bills is state income tax free, but you're still paying federal taxes, so it's hard to get around the federal side.
Okay, that's great to know. Somebody asked about where to place like emergency funds. Is it better to do in a high yield savings account or just a regular one? Which one would you guys recommend?
Well, I'd recommend the high yield.
Okay.
Obviously, because you're getting higher yield, higher potential for interest, and I say growth loosely. We're not using a high yield money market or a high yield savings for growth. It's truly for the emergency or the rainy day fund. I think the difference between the two is savings accounts at your bank are going to have FDIC insurance. So they are federally insured in terms of insolvency if the bank were to have an insolvent event up to certain limits. High yield money markets, they don't have that FDIC insurance. So sometimes I think that's where people get hung up on money markets, but realistically, money markets and high yield savings, they're investing in extremely safe short-term debt instruments, primarily issued by the US government. And the US government, for all the white noise that we hear, has never defaulted on its debt. So again, having perspective is important.
Perfect. Our next question is more so about the difference between a 401k, 403b, and a Roth IRA, and maybe talk about like the different benefits of each.
It's like right up Julie's aisle on all the employer benefit plans.
Yeah, 401ks, 403bs, you may hear the term 457s. These are all retirement benefit plans issued by employers. 401ks primarily are issued by, private sector employers. Think of Fidelity or Amazon or BlackRock, for example. They're going to have 401k plans. By the way, these terms 401k, 403b, 457, they're tax codes. So these tax codes that are written in by the IRS mean that when you participate in these plans, you have tax advantages. So tax deferred growth. If you're able to contribute Roth, it's tax-free growth. So it's these benefits that are offered through employers, and you're going to contribute to those plans by way of your, in most cases, biweekly payroll or however often you get paid. The money's just going to come directly out of your paycheck. Roth IRAs or traditional IRAs, those are individual retirement accounts. So I tell people, your 401k is employer sponsored. Your employer is offering you this benefit. A Roth IRA or a traditional IRA is individually sponsored. You are opening it yourself, contributing to that from your own monies on the sidelines, and investing that as well. So you're allowed to play in both sandboxes. You can contribute to both your 401k and you can also contribute to an IRA.
Perfect. Our next question is actually about couples, or I'm assuming a dual income household. So their question is, should a young couple early in their careers prioritize maxing out their retirement contributions or simultaneously invest in retirement and stocks? So
You may be able to do both because within your retirement plans, your investment options are definitely going to include some version of stocks, whether they're packaged in a fund of some sort or whether you have a separate brokerage option within your 401k, which some like larger employers would offer that option as well, so that like rather than just selecting from a menu of funds, you could also invest in individual stocks. Um, but I would say the important thing, if you're in a position to max out your retirement plans, that is a great way to fast track your way to potentially an early retirement. So I personally love that option, and you can invest within your 401k plan according to like your risk tolerance.
that's great to know. And Erica, just to talk about YNAB a little more, is there options on the app to like take in like dual income households, or is it strictly just individualistic?
Great question. We have a feature called YNAB Together, so it's designed specifically for family members or close-knit friends, not just like a roommate, because you would be able to view each other's plans. But for the cost of one subscription, you can invite up to 5 family members or close-knit friends. So, and then it's up to you. We actually have some like budgeting with a partner guides that have a lot of different recommendations depending on if you have shared accounts, separate accounts, or a mix of both, and how best to set that up.
Perfect. That's great to know. There's a question about actually credit unions. So this person asks, would you recommend switching to a credit union for checking accounts or sticking with major bank chains post-grad if you're currently banking with a major bank chain?
I personally don't see like a day-to-day functional difference in terms of like that bank's capability to offer you a savings or checking account. But it might come down to like their networks, how many ATMs do they have, or what fees that they would be applying to your account. So I think it really just comes down to how you're using the account more so than the specific institution that's offering the service.
Perfect. Um, we also have a question in terms of, it's also a partner question. So it says, what suggestions do you have for budgeting and investing with a partner? What have you seen work in the past?
I've
Well,
seen people really all over the map on this. How about you, Julie?
Yeah, some people are like, I don't even plan with my spouse or my partner, and and then some people, everything is joined in. I would imagine everybody's situation is very unique. But I think having the open dialogue is important. So having those conversations, while they may be weird, um, you need to know what you're spending, each of you. You need to know what you're bringing in, each of you. Otherwise, it's going to be difficult to live under one roof.
It's very fair. Transparency is important. Um, Another person was asking about when is it possible to switch from a Roth IRA to a traditional one, and is that even recommended?
Well, there's no aha moment. Okay, it's time to switch from Roth to traditional or vice versa. But there is a rule where the IRS does limit the ability to contribute directly to a Roth IRA based on your modified adjusted gross income. So that's kind of a easy line in the sand to have. I have to look up my notes. This year, if you're a single filer, I think it's 153,000. If your modified adjusted gross income is greater than that, then you can't contribute directly to a Roth IRA. If it's married, I think it's 250. It's somewhere in these guidelines or in these ranges. Now, it doesn't mean that you can't get money into a Roth, but this gets a little bit more nuanced. We have to do strategies like a backdoor Roth IRA. So I wouldn't say that there's necessarily a clear, like I said, timeline as to when it would make sense to move from Roth to traditional or vice versa. Again, one thing too, there's another IRS ruling that states that if you're covered by a workplace retirement plan, so you have a 401k, and if your income is over 78,000, then you can't receive a deduction on a traditional IRA contribution. So why would you wouldn't want to commingle a non-deductible contribution in a traditional IRA with tax deferred growth opportunity? You're going to create a tax mess. So not to say that traditional IRAs are bad, but I would really look more towards the Roth and keeping that for the longer term. There's just more tax advantages when it's compounded over a long amount of time.
Perfect. That's great to know. The next question is more so about taking profit from stocks and investing. At what point should a person take those profits out from those stocks, or should they reinvest it?
I think there are a lot of like mechanisms for when to take profits or when to rebalance, if you will. Um, and in general, though, if you buy a stock, the best sort of term of ownership we think is forever, unless you actually need to spend the money. So you could change your mind if you see a different like investing thesis or like the reason that you bought the stock isn't really playing out. You can reallocate that to a better idea. If it starts becoming too big of a part of your portfolio, if you bought NVIDIA 20 years ago, it's probably become a really large and outsized portion of your portfolio that now has so much risk associated with it that you're kind of betting the farm on one position. You would definitely want to trim that. I think it all just comes back to what is the purpose of all of this capital to begin with? Is it to grow? Is it to pass on to your kids? Is it to leave, have your stadium named after you in the future, make a big charitable gift? Is it to spend? If your goals are to spend this money, you will have to sell the stocks at some point. There's no getting around that. And the best thing you can do is look at each time you need to spend money as an opportunity to sort of trim some of the risk in your portfolio.
Perfect. That is definitely an insightful way to go about that. And for our last question is, I would like each of you guys to give a recommendation for a high yield saving account. That's like a recurring question in the chat. So if you guys have any recommendations for that.
Okay, well, I don't mean to plug Fidelity, but I will. So if you go to fidelity.com and you open just what we call a brokerage account, brokerage account means it's liquid. You can access the money at any time. There's no time restrictions like retirement accounts where you have to be 59 and a half. But it's also, brokerage accounts, just keep in mind any interest, dividends, growth that are realized are going to be taxable. So we call them taxable accounts. But if you were to just open a brokerage account with Fidelity, we automatically put you in what we call our core position. And our core positions are high yield money markets. And I think today it's probably yielding 3.3%. So.
We can move on to Erica if you have a suggestion.
I don't totally feel qualified promoting this. I personally have, oh, am I muted? No, a SoFi high yield savings account. It works well for me. I was just trying to find the rate. Actually, I don't know how it compares these days, but when I was searching around a couple of years ago, the rate was pretty good.
Perfect. We can do Ellie and then Megan to end us off.
Yeah, me personally, honestly, I put my money in a money market fund. So like I have my brokerage account with Schwab. So any of the cash that I'm just sitting on and waiting to invest for a right opportunity, I'd put it in one of their money market funds. It probably yields realistically the same, maybe 1 or 2 basis points below or above something like what a Fidelity high yield savings account is. But I just like the beauty is that I could sell that amount and then buy any stock I want right away. And I think you could do that in a high yield savings account too, but um, they're kind of, again, extremely low risk. You're basically just earning whatever inflation will be, maybe a little higher, and just retaining the value of the money.
Perfect. And Megan to end us off.
Great. I know Ellie mentioned before NerdWallet as a resource for like best credit cards for a specific category. I know they also have a platform for, best savings accounts, best checking accounts, things like that. When I was a young graduate, I actually did a lot of like sort of what they call bank account hacking because a lot of institutions will offer like a sign up bonus associated with establishing a new account, setting a certain number of direct deposits, and things like that. So you could look at that as a way to sort of top up in addition to whatever the normal rate or yield would be on a bank account. You would also get that like incentive for starting the account. And typically banks are offering that because they want you to be a long-term customer. And, over time, you will continue banking with them. That's great, but that's the chance that they take by offering these sorts of promotions. So, if you do have the flexibility in your cash flow and your savings capacity to sort of have multiple savings accounts that have some sort of bonus associated, that can be a way to kind of build in some additional return.
Hey, thank you guys for such wonderful answers, and thank you for the audience for such great questions. So I'm going to hand it to Lori to end our webinar tonight.
Thank you, Jayla. Yes, 29 questions. They were all fabulous. And thank you to our speakers. I want to give a big USC thank you to our esteemed speakers, Julie, Megan, Ellie, and Erica. We're grateful for your gracious donation of time and your expertise to educate the USC Trojan family on financial wellness. A big USC thank you to Simone and Cole at the USC Alumni Association for their collaboration and partnership. And last but not least, a big thank you to Jayla Eloy, who led the planning of this event and shared her wisdom of what students need to know about budgeting and investing. And with that, I'll say good night and fight on. Take
Right
care,
on. Thank you.
everyone. Bye-bye.
Take care.
Everyone.
I guess I'll stop the recording.